viewers, it's my name at IAS Academy, and in this video we are going to discuss about budget. We are going to discuss about revenue, capital, revenue receipt, revenue expenditure, capital receipt, capital expenditure. We are also going to discuss budget deficit, fiscal deficit, and then primary deficit, and then fiscal stimulus, fiscal consolidation, and FRBM Act. These are the things which we are going to discuss in this video. So watch this video till the end. In our last video, fiscal policy part 1, we discussed what is fiscal policy. Actually, fiscal policy is nothing but it deals about government's income and government's expenditure. So fiscal policy, it is a set of government decisions regarding the taxation, expenditure, and subsidies and other financial operations. It deals about these things. Through this fiscal policy, government can increase the socio-economic welfare of the people by introducing some schemes. Example, by MGNREGA Act, Mahatma Gandhi National Rural Employment Guarantee Act. Through that, it can increase the employment. So fiscal policy can be used to increase the employment. Through fiscal policy, we can fight inflation as well as deflation. Through fiscal policy, we can control the money supply, by which we can fight the inflation as well as deflation. In our last video, we also discussed about the funds in India. We discussed about Consolidated Fund of India, Contingency Fund of India, and then Public Accounts of India. And we also discussed about budget. Budget, Article 112 talks about budget. Budget is nothing but it is annual financial statement. In our constitution, it says budget as annual financial statement, and we discussed about financial bill. Article 117 talks about financial bill. Financial bill 1, financial bill 2, and money bill. All these things together called as financial bill. So money bill is also a financial bill. So article 110 talks about money bill, and money bill should be certified as a money bill by the speaker, and it should be introduced only in Lok Sabha. It can be introduced only in Lok Sabha. And Shankaracharya committee in 2016 recommended to change the financial year from January to December 31. But actually what we follow now is different. It is from 1st April to 31st March, and we discussed vote on account interim budget, and we discussed who publishes the economic survey. Actually, it is chief economic advisor who publishes the economic survey, and economic survey has 2 volumes. Volume 1, which is important for UPSC mains, and volume 2, which is important for prelims, because volume 2 contains past year data, whereas volume 1 contains future projections and future plans. And we discussed about chief economic advisor. Chief economic advisor is not a constitutional post, and his tenure is for 3 years, and he works under the Ministry of Finance, under the Department of Economic Affairs. And we discussed about the things which come under departments which come under the Ministry of Finance. Under Ministry of Finance, we have Department of Economic Affairs, Department of Expenditure, Department of Revenue, Department of Financial Service, and DIPAM. DIPAM is very important because DIPAM is the one which do disinvestment. DIPAM full form is Department of Investment and Public Asset Management. Earlier it is called as Department of Investment, but now it is called as Department of Investment and Public Asset Management. Why? Because this is the one which is responsible for disinvestment. It recommended disinvestment. It recommended to sell LIC, railways, airline, etc. And we have another one department called as Indian Audit and Accounts Department. We have seen all those things in our fiscal policy part 1. If you have not seen that video, you can see that in this video, fiscal policy part 2, we are going to discuss these things. So let's get started. First one is revenue. Budget is divided into revenue as well as capital. Inside revenue, we have revenue receipt as well as revenue expenditure. Revenue receipt is nothing but government's income. Receipt means it deals about income, whereas expenditure means the expenditure which government is having. Government's expenditure may be the income for our households, but we are going to talk in government side. So revenue expenditure is government's expenditure, revenue receipt is government's income, capital receipt is also government's income, and capital expenditure is also government's expenditure. We are going to see what is what. First, inside revenue we have 2. One is revenue receipt and one is revenue expenditure. Revenue receipt, under revenue receipt we have tax as well as non-tax. Government can get income through taxation and also by other forms. So other forms are discussed as non-tax. Under taxation we have direct tax as well as non-direct tax. Through direct tax also government gets some income, and through non-direct tax also government gets some income. In non-taxation method also government gets some income. Example, we can say through transport. We are using transportation facilities of the government, through which government is earning, because we are going to pay some money for the ticket, right, through which government is earning. So for transportation, through transportation facilities which government has gave us, through which it can earn. Through dividend. government can buy a portion of a bank, portion of an organization, and for that particular share, a dividend will be paid by that particular organization. So, share of the profit. Say for 100%, 20% share, if it is owned by government, for this 20% share, they give some amount as profit. If there is a profit, it shares with the 20% which is owned by the government. So the profit which is given to the government because of the shareholding is called as dividend. Then we have interest. If government has given a loan to a state, or if it has given a loan to some other thing, for that loan it gets some interest rate, and that comes under non-taxation income. So these are the things which are income. These are revenue receipts. This is also income. This is also income. Then what is the difference between these two? You might guess. You might think these things, but actually revenue receipt is the one which is a normal income. It is a regular income that government is having. Revenue receipt. Whereas capital receipt is an abnormal income. Why it is abnormal? Because capital receipt can be divided into two. One is debt, another one is non-debt. In debt, we have, if government is going to borrow money, the government can borrow money from an international organization, it can borrow money from any other means, it can borrow money in any banks also. If government has got money from borrowing, then it comes under capital receipt, which is not good for us because we need to repay it in some time, right? So it is not good for us. Debt is not good for us, but in certain cases debt is good. Why? Because if we have got some borrowing and if it was utilized in a very correct manner, then it might be good, but we need to repay this. So it is needed to be repaid. So it is an abnormal income. Then through non-debt method also we can get an income which is also abnormal. How is? Through disinvestment. Disinvestment means if government is having 100% of share in a company, 100% share means if government is owning a company or an organization, then it can sell portion of it to a private entity. Say if it is going to sell 51% of its share to a private entity, then it becomes a private organization. Example, airlines. Government is planning to sell railways. If government is having 100% of share in railways, and if it is going to sell 51% of the railways to some other organization or some other private entity, then railways will be privatized. That is called as disinvestment. Through this disinvestment also government will earn money because this 100% may cost you 100 crore rupees, say. Then by selling this 51%, government will get 51 crore rupees. So this 51 crore rupees is government's income which it has got by selling an organization, by selling its asset. So it is not good. So disinvestment is also not good. Then we have loan recover. This is okay, but it is an abnormal income. It doesn't happen regularly. If a loan is recovered, then it comes under capital receipt. This is the difference between revenue receipt and capital receipt. In revenue receipt, it is a regular income. It is regularly obtained by the government of India through taxation or through non-taxation methods. Through taxation method, it has many types of taxation. We have income tax, corporate tax, we have indirect taxes, we have value-added tax, we have GST, and we have custom tax. We have many types of taxes. Through taxation, government can get an income, and through non-taxation methods, through transportation, through interest amount which is paid to the government, through dividends which is paid, and profits, government can get an income, and those are the things which come under non-taxation. Whereas capital receipt is abnormal income. In capital receipt, we have debt as well as non-debt. Debt is by borrowing. If government has borrowed some amount of money from a bank or any other international organization, those things come under capital receipts. Whereas in non-debt, we have disinvestment as well as loan recover. Disinvestment means government selling its asset, portion of the asset to a private organization is called as disinvestment, and this reduces the government share. That is disinvestment through which government can earn, but it is an abnormal income. And loan recover is also not a regular thing, right? So it is also abnormal income. This is the difference between revenue receipt and capital receipt. And then we have revenue expenditure. Revenue expenditure means government needed to spend something to the people also. Government need to maintain some organizations for which government need to spend something, and these are the regular expenditure that government have. In revenue side, we have regular income as well as regular expenditure. So a regular expenditure means government is running transportation. We have government buses, We have government hospitals, government schools, government colleges. For all these things, government need to manage some workers. Government need to hire some workers and they need to pay salary for those workers. They need to pay pension for those workers. And those things come under this. The salary which government need to pay for the government teachers, government doctors and all those things come under revenue expenditure. And pensions which government need to pay for the government workers comes under this. And also subsidies which government give for the people of government of India also comes under this. And the grants which government give to states and other things which also will also come under this. The grants, subsidies, salaries as well as pensions come under the revenue expenditure. And then we have capital expenditure. This is a regular thing which is done. We need to spend this to maintain the organization. This is common. Whereas capital expenditure is good. How capital expenditure is good? Actually, capital expenditure we have infrastructure development. If government is going to invest something for infrastructure development, then it comes under capital expenditure. Say if government is going to invest 1,000 crore rupees to build a hospital, government hospital, then this comes under capital expenditure. So if government is going to build a government school for 1,000 crores, then this comes under capital expenditure, which is good. How is through this infrastructure it can earn money. This infrastructure, which is an investment, can bring profits to the government of India later. So it is an investment, so it is good. And loan giving loan to the other organizations, giving loan to other countries comes under this, because by giving loan we get interest. Those interest we get asset income, right? So it is also good. And if you are buying defense equipment, say if you are buying missiles and other defense equipments, those come under capital expenditure. These are the things which come under budget. And after this we will discuss about what is deficit and what are the things. We have primary deficit, fiscal deficit and revenue deficit, capital deficit. We will be discussing all those things. Okay. First let us see what is deficit. What are the types of deficit? Actually, there are two types of budget. One is surplus budget and another one is deficit budget. First, what is surplus budget? In surplus budget, the expenditure will be lesser compared to that of receipt. So, the total receipt means revenue receipt plus capital receipt will be greater than expenditure, revenue expenditure and capital expenditure. Which means government income is greater than expenditure. If government's income is greater than expenditure, then it is called as surplus budget. Whereas deficit budget means if government expenditure is greater. If government's expenditure is greater than government's income, say receipt, combination of revenue receipt and capital receipt, then it is called as deficit budget. These are the two types of budget which we have. And generally we have deficit thing. And we also seen a thing called as inflationary gap and deflationary gap while seeing inflation. Inflationary gap means if government's expenditure is greater than government's income, then it is called as inflationary gap. Whereas deflationary gap means shortfall in government spending, which means that expenditure is less compared to that of government income. Then it is called as deflationary gap. This is also something relating to it. And then we have revenue deficit. First, revenue deficit means revenue deficit is equal to revenue expenditure. We have revenue expenditure minus revenue receipt. If revenue receipt is lesser compared to that of revenue expenditure, then it is called as revenue deficit. Here in revenue deficit, the government's revenue expenditure is more compared to that of revenue receipt. Then it is called as revenue deficit. And then we have budget deficit. First, let us see capital deficit. In capital deficit, government's capital expenditure is high compared to that of capital receipt. But it is okay. It is good. Why? Because its capital expenditure is good. If capital expenditure is more, it is okay. So, capital deficit means capital expenditure minus capital receipt gives capital deficit. So, capital expenditure is more compared to that of capital receipt. These are the basic two deficits. Then we have three types of deficits. three types of deficits. One is budget deficit, second primary deficit, and third we have fiscal deficit. So we are going to see these three deficits. First one is budget deficit, whereas budget deficit is equal to revenue expenditure plus revenue plus capital expenditure minus revenue receipt plus capital receipt. So budget deficit is equal to revenue expenditure plus capital expenditure minus revenue receipt plus capital receipt, which means that revenue deficit is the difference between the receipt and the expenditure, total receipt and the total expenditure. So revenue receipt plus capital receipt gives the total receipt, and the revenue expenditure plus capital expenditure gives the total expenditure. So budget deficit is the difference between total receipt and total expenditure. If total expenditure is more compared to that of total receipt, then it is called as budget deficit. This is the first one. Then we have primary deficit, whereas primary deficit is equal. Then we can see fiscal deficit. So fiscal deficit is equal to total expenditure. So total expenditure, we have revenue expenditure plus capital expenditure. Total expenditure minus revenue receipt. Revenue receipt is subtracted plus, this minus capital receipt but excluding borrowing. So earlier we have seen what is capital receipt. In capital receipt we have debt as well as non-debt. In debt, government can borrow. The amount which government has borrowed comes under debt. And in non-debt we have disinvestment and loan recover. So here in fiscal deficit, generally in budget deficit, what we have done is we gave a difference between the total expenditure and the total receipt, whereas in fiscal deficit it is total expenditure minus revenue receipt minus capital receipt, in which in capital receipt borrowing is excluded. This is the important thing which you should remember. Excluding borrowing gives fiscal deficit. So fiscal deficit is equal to total receipt minus total expenditure minus revenue receipt minus capital receipt excluding borrowing. That gives fiscal deficit. And then we have primary deficit. In primary deficit, it is equal to fiscal deficit minus interest payments. Primary deficit is equal to fiscal deficit minus interest payments. So interest payment is nothing but the interest amount which you have paid on your previous loans is interest payments. So primary deficit contains fiscal deficit minus interest payments, which means primary deficit is the difference between the fiscal deficit and interest payments. So from fiscal deficit, interest payment is subtracted. The amount which you have paid for your loan. For previous loans, you would have paid an interest, right? That amount is subtracted from your fiscal deficit to get primary deficit. These are the three types of deficits. So we have seen revenue deficit. Revenue deficit means revenue expenditure is more compared to revenue receipt. We have seen capital deficit. In capital deficit, capital expenditure is more compared to capital receipt. And then we have seen budget deficit. In budget deficit, the total expenditure is more compared to that of total receipt. Then we have seen fiscal deficit. In fiscal deficit, from capital receipt, borrowing is excluded. That is the only difference. From capital receipt, borrowing is excluded. Therefore, fiscal deficit is equal to total expenditure minus revenue receipt minus capital receipt excluding borrowings. And in primary deficit, it is fiscal deficit minus interest payments. Interest payments means the amount which you have paid as interest on your previous loan is interest payments. These are the things which are relating to deficit. And after this, we have fiscal consolidation. So what is fiscal consolidation? So fiscal consolidation is nothing but fiscal consolidation involves government trying to reduce its expenditure. If government tries to reduce its expenditure, then it is fiscal consolidation. It is to control the fiscal deficit. If there is a fiscal deficit, then government will try to control its expenditure. Then it is called as fiscal consolidation. So in fiscal consolidation, government will try to reduce its expenditure. Why? Because there is a fiscal deficit. Through this fiscal consolidation, it can bring a balance between the receipt and the expenditure. This is what done, and through this, by doing this fiscal consolidation, while doing this fiscal consolidation, government will also try to reduce the leakage. Example, we can say direct cash transfer government will give. For this, why government give direct cash transfer is to reduce leakage. They give direct benefit transfers to the people. Example, we have for LPG, government will give some subsidy which will be transferred to the bank account. This is done to reduce the leakage, to reduce illegal transactions and all that. Government will introduce schemes. Why? Because this to reduce the government expenditure, to use the government expenditure in a very wise manner. It does certain policies. Those things come under fiscal consolidation. Then we have fiscal stimulus. What is fiscal stimulus? If there is if the economy is so slow, if there is a slowdown in economy, government will try to boost the economy. For boosting the economy, what government do is it will bring some schemes. It will bring money flow inside the market. It will bring liquidity inside the market. So that is called as fiscal stimulus. So government will increase money flow in the market. How it increases? It can increase by increasing its expenditure. If government has increased its expenditure, money flow in the market will increase, which will boost the economy. By doing this, it will boost the economy. Fiscal stimulus is done to boost the economy. While there is a slowdown in economy, it is done. So these are the things relating fiscal stimulus. And then last thing which we have is FRBM Act. FRBM Act 2003. FRBM Act, full form is Fiscal Responsibility Budget Management Act 2003. Fiscal Responsibility Budget Management Act 2003, it was laid and it said that the government will reduce the fiscal deficit by 3% of the GDP within 2008. It is the target which is set by this act. Within 2008, government will reduce its fiscal deficit by 3% of GDP. Which means that if government is earning 100 rupees, it can have fiscal deficit of 3 rupees. Not more than that. This is the target which is set, but government has not accomplished this target, and this 2008 was postponed. It was postponed and a committee was set up to review why it can't achieve this target, and that committee is called as FRBM Review Committee. FRBM Review Committee is set up to check why government can't achieve this target. And this committee, FRBM Review Committee, is headed by N.K. Singh. N.K. Singh headed this FRBM Review Committee, and it gave some ideas how it can achieve this target. It gave some ideas, and those ideas are, it said to reduce the loan which is given to farmers. It said government should not give loan to the farmers, and it also said a thing called as escape clause. Escape clause can be introduced. So what is this escape clause? Escape clause is very important for your UPSC civil exams, because in escape clause it says that during a war or during period of drought or during an economic crisis, government can temporarily allow to breach this target. So this is what done now, right? So if there is an economic crisis or if there is a war or a drought, government can breach this target. That is called as escape clause. So in 2008 to 9, then this 2008 is actually shifted and we made it as 2018 to 19. We should achieve fiscal deficit should be 3.4%. We changed this 2008 to 2018 to 19. It said that fiscal deficit can be 3.4%, and in 2019 to 20 fiscal deficit should be 3.3%, and in 2020 to 21 fiscal deficit should be 3%. This is what said at last, but in 2024, this is the future thing which we have a target. In 24 to 25, we should continue this 3%. They have not said more than 3%. In 20 to 21, we should achieve this 3% fiscal deficit, and from 24 to 25 also we should continue this 3%. This is what said, but due to the current situation, it is a question mark. We can see about how much fiscal deficit we are having, how much budget deficit we are having, and we can discuss the actual factual data that we have while we are discussing the economic survey and budget. Okay. So these are the things which are relating to fiscal deficit, and we should see another one thing relating to fiscal policy itself. We should see taxation. In revenue receipt we have taxes as well as non-taxes, right? In direct tax and indirect tax we have both things. We should discuss about direct tax as well as indirect tax. We can discuss those things in our next video, and we also need to discuss about finance commission. We can discuss all these things in our upcoming videos. So subscribe to My Lemonade IAS Academy. Thank you.